Imagine you are running a business that operates in multiple countries. You are thriving, expanding, but suddenly you are hit with taxes from several governments. This will surely leave you confused. And that is where international taxation comes into play. International tax is the intricate system of laws and regulations that govern how income is taxed when it crosses borders. It is the framework that ensures businesses, individuals, and even governments navigate the complex web of global taxation without getting caught in the traps of double taxation or tax evasion. International taxation is about ensuring fair taxation, protecting national revenues, and fostering economic development. It governs the rules, treaties, and systems determining how cross-border income, profits, and transactions are taxed. In this video, we will examine the key principles of international taxation, its challenges, and implications for businesses and policy makers. Watching this video till the end will unravel the complexities and help you make sense of global taxation. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Let's start with the core principles. International tax systems are built on fundamental principles that guide how cross-border income is taxed. These principles aim to balance fairness, efficiency, and revenue generation, and they include source-based and residence-based taxation. Source-based taxation means income is taxed where it is generated. For example, if a company earns profit from a factory in South Africa has the right to tax that income. In contrast, residence-based taxation focuses on where the taxpayer resides. For example, a resident company in the United States may be taxed on its global income no matter where it is earned. Tax neutrality. Tax neutrality ensures that taxation doesn't distort economic decisions. Capital export neutrality ensures that investors are taxed equally on domestic and foreign investments. Capital import neutrality ensures businesses face the same tax burden whether they are domestic or foreign. Avoidance of double taxation. Double taxation occurs when the same income is taxed both in the source and residence countries. To prevent this, mechanisms like exemptions, tax credits, and tax treaties are used. Challenges in international taxation. The complex and evolving nature of international taxation presents significant challenges for businesses and policy makers. These include double taxation and disputes. Businesses face high tax burdens when income is taxed in multiple jurisdictions. Complexities also emerge in interpreting tax treaties, especially concerning transfer pricing and permanent establishment thresholds. Tax avoidance and base erosion. Multinational corporations often employ strategies like transfer pricing, treaty shopping, and tax havens to shift profits to low-tax jurisdictions. These strategies significantly erode the tax bases of high-tax countries, depriving them of essential revenue. Digital economic taxation. Traditional tax rules, which rely heavily on fiscal presence, are increasingly inadequate for digital businesses that operate globally. Policymakers struggles to ensure fair taxation of tech giants operating across borders without fiscal oppression. Compliance complexity. The diversity of tax laws, administrative procedures, and reporting requirements across countries adds layers of complexity for global businesses. Tax competition and race to the bottom. In their bid to attract foreign investment, countries often engage in tax competition by lowering corporate tax rates, leading to a race to the bottom. While this strategy can boost short-term investment, it ultimately reduces the global tax base and fosters economic inequalities between nations. Economic implications of international taxation. Impact on businesses. Taxation significantly affects investment decisions, profitability, and competitiveness. Companies adopting effective tax planning can reduce tax burdens while ensuring compliance. Impact on governments. International tax policies directly influence revenue mobilization, economic growth, and inequality. Developing countries often lose significant revenue due to tax avoidance by multinational corporations. Equity and fairness. Addressing tax avoidance ensures that businesses contribute fairly to the economies where they operate, reducing inequality. Opportunities in international taxation. Despite its complexities, international taxation offers numerous opportunities for both businesses and governments to optimize their operations and enhance economic growth. This includes tax planning and optimization. Businesses can leverage double taxation agreements, exemptions, and tax credits to optimize global tax positions. Leverage digital tax frameworks. Governments can modernize tax systems to include digital services tax, ensuring fair contribution from tech-driven industries. Promoting regional integration. Regional harmonization of tax rules within blocs like ECOWAS or the European Union can reduce compliance costs and foster economic integration. Adopting advanced technology. Tax authorities can use artificial intelligence and blockchain to enhance transparency, reduce fraud, and streamline compliance. Fostering sustainable tax practices. Align tax policies with global sustainability goals, such as green taxes or incentives for renewable energy, can drive economic growth and environmental protection. Recent trends and development in international tax. 1. OECD Global Minimum Tax. A landmark agreement aims to impose a 15% global minimum tax on large multinational corporations. Pillar 1 reallocates taxing rights to market jurisdictions. Pillar 2 introduces the global minimum tax to curb tax competition and profit shifting. 2. Digital tax. In response to the unique challenges posed by digital businesses, countries like France, India, and Kenya have implemented digital services tax (DSTs) to tax revenue generated by digital platforms and services operating within their jurisdictions. 3. Transparency initiatives. Frameworks like country-by-country reporting require multinational corporations to disclose income, profits, and taxes paid in each jurisdiction. The Common Reporting Standard facilitates automatic exchange of financial account information between tax authorities. Rise of regional tax cooperation. Regional organizations like the European Union and African Union are working to harmonize tax rules and combat base erosion. Now, let us examine a few illustrative case studies to better understand the complexities and impact of international tax policies. Case study 1. Transfer pricing dispute. A global tech company faced a $14 billion tax claim in the European Union for transfer pricing arrangements that shifted profits to a low tax jurisdiction. This highlights the importance of robust transfer pricing documentation. Case study 2. Digital tax in India. India's equalization levy taxes revenue from online advertising and e-commerce activities by non-resident digital businesses. This provides a model for addressing taxation challenges in the digital economy. Case study 3. BEPS implementation in Nigeria. Nigeria's adoption of BEPS action plans has strengthened its ability to combat profit shifting, particularly through stricter transfer pricing regulations. In conclusion, understanding international tax is essential for navigating the complexities of cross-border transactions. While challenges like tax avoidance, digital economic taxation, and compliance complexity persist, recent developments such as the global minimum tax and increased transparency offer promising solutions. International taxation will continue to evolve as globalization deepens and new business models, especially in the digital economy, challenge traditional tax framework. This evolving landscape will play a key role in shaping global economic growth, fostering fairness, and promoting greater equity in the distribution of tax burdens. Thank you for joining us on this enlightening journey. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos.